Okay, now if you're going to see different data here in this mini lecture, I've moved to the tab entitled Finance, and I'm only going to work with this table here. We actually work with this table in class on Friday, what would have been December 2nd. And but look, I want to talk to you a little bit about what these data mean and why we do statistics, okay, on this type of data. Is one of the really big deals in finance. And even if you're not a finance major, you'll actually encounter this in Finance 340. For those of you who take Finance 340, one of the things that's a really big deal in finance is to try to have a diversified portfolio. Okay, a diversified portfolio, and actually one of the most common ways that we assess how diversified the portfolio is we look at the correlation amongst the stocks, or sometimes we'll look at the correlation amongst our portfolio and different returns. So I took a stock which I called it Acme to protect the name of the actual company, and then I got monthly stock returns on the NASDAQ exchange and monthly returns on the Dow 30 exchange. Okay, so there's all kinds of things we could do here. We could do an ANOVA with these data. We could do multiple regression. We actually could do simple regression. But what we're really interested in here is the correlation amongst our stock, Acme, and amongst the NASDAQ return and the Dow return to help us investigate or assess whether adding Acme to our portfolio, let's assume for the moment that we don't own the Acme stock, it helps us assess whether adding Acme to our portfolio would actually help diversify the portfolio. And what would be an indicator that Acme would help diversify our portfolio is if Acme was either had a low or a statistically non-significant correlation with either the Dow stocks, with either the NASDAQ stocks or with the Dow stocks, okay? So we're just going to do a correlation analysis here. So I'll click on add-ins, and I go to Megastat, and I drag down to correlation/regression, and I go over to correlation matrix, okay? And now it just asks for the correlation, so I highlight my column headers as well as all the data. All right, and I click on OK. And remember, we're interested in whether Acme can help diversify our portfolio, okay? If Acme can help diversify our portfolio, we might decide to add Acme if we think it's going to be a decent stock. We might decide to add Acme not only because we think it'll have good returns, but because we think it will reduce the riskiness of our portfolio by increasing kind of like the diversity of our portfolio. So we see here that Acme and the NASDAQ return really aren't correlated with one another. The observed correlation is about 0.08, okay? Whereas with the Dow 30, Acme is correlated at 0.76, quite a high correlation. So if we're working with a portfolio of primarily Dow stocks, Acme doesn't help us in terms of the diversity of our portfolio or diversification of our portfolio. But if we're working with a portfolio of NASDAQ stocks, then adding Acme to our portfolio can actually help us from the standpoint of increasing the diversification of our portfolio because it's not correlated with the NASDAQ stocks. And notice here then, not surprisingly, that the Dow stocks and the NASDAQ stocks show that they're either not correlated, or if we had a bigger sample size, we would show that they're weakly negatively correlated. Okay? All right. So again, a real common thing that we do in the investment world, and something that you're likely to run into in MBA 540, is you'll be asked to assess whether a particular stock, in this instance Acme, whether a particular stock would increase or decrease the diversification of a portfolio. And one of the ways that you do that is just by looking at the correlation matrix and the correlation of Acme with, in this instance here, two other stock returns, or you could look at it compared to individual stocks as well. Thank you.